Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. To get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. The Saretsky Report for May 2019 is now available, so if you want that, check the description below. There's a link there where it's basically a comprehensive overview of my thoughts, comments, graphs, charts on the Vancouver housing market for May 2019. You can also sign up in the report for regular once a month emails for the next reports that come out every single month. So I highly encourage you to check that out. But I actually want to do this video basically on the May housing market in Vancouver. I mean, sure, we can touch on Toronto, but there's a couple things that will obviously regardless of what housing market you're in Canada are relative to you. But again, here in Vancouver, people are talking about the busier month in Vancouver. One thing I've come to appreciate and understand is that you can really only focus and concentrate and be an expert on so many particular subjects. And so what I try to keep this focus to is really Vancouver and the broader Canadian housing that will actually impact particular markets. But for the most part, I try not to comment. Everybody's always got an opinion on a thought, but I think for the most part, unless you're actually living in the market every single day, looking at all of it, that's why I don't come out here and start commenting, on stocks and different sectors. I don't start talking about Bitcoin and the Canada sectors. That's not my space. Certainly, I might have opinions on it, but I've come to appreciate in order for me to provide value is to sort of stick to what you know, and I feel like we've certainly gotten there in this aspect. So if we're looking at the Vancouver housing numbers, where do we start? I mean, people talking about busier month for Vancouver, picking up from April, but again, it's always in context. I mean, if we look at the detached sales figures, so everything I talk about today is basically going to be for the city of Vancouver, but understand that the city of Vancouver is where it all happens, and then it spreads out into other areas. So it's all basically relative. So if you live in the suburbs and you're all upset, don't worry. Whatever happens in Vancouver is most definitely coming to you if it hasn't already come there already. Detached sales numbers for the city of Vancouver, it was the slowest May since 1991. This is as far back, unfortunately, as the data goes, if you want to segment it by property segment. So, I think that number kind of speaks for itself. Obviously, still very weak sales figures in the detached housing market. This allowed prices to basically fall year over year per the MLS benchmark, which is really a smoothed out indicator. It suggests that prices fell 13.6% on a year-over-year basis in the city of Vancouver. Basically a 14% drop in prices in one single year, I think is obviously substantial, and it shouldn't be surprising given how weak the sales volumes are. You basically have a 28-year low in sales figures. So one thing to point out is it's interesting that new listings fell off, and the months of inventory actually has dropped quite a bit. I think it's still elevated at 10 or 11 months, but in order to see continued downwards pressure on prices, you will have to see months of inventory, basically supply, increase to put the downwards pressure on prices. But that remains firmly intact, and obviously the detached market plays a significant role in what happens in the condo market, right? If prices in the detached market continue to fall, then clearly that puts pressure on the condo market, right? There's no sense in paying $1 million for a condo if a detached house is 1.2. And so if we transition, that's pretty much the same thing as what you're seeing in the condo market. In the city of Vancouver, the condo sales were the lowest since 2001, so it was like an 18-year low in condo sales. So yes, they picked up considerably on a month-over-month basis, but still very low when we actually contextualize it. So I think that's important to understand. One thing that I will say is the months of inventory for condos has actually fallen off quite a bit, and the months of inventory actually today sits at just under 5 months of inventory, which is actually considered balanced. And so that, if you're looking for more significant drops in the condo market, you're actually going to have to see the months of inventory increase quite a bit. And right now it's at, it's at 5 months. I suspect that with a lot of the new supply coming, and I think sales are going to continue to remain weak in the foreseeable future, that months of inventory should climb. But as it stands right now, it is pretty much balanced. So that is important to understand and contextualize. And this is what you can see. If you look at the MLS benchmark, prices were down just under 6% on a year-over-year basis in the condo segment. So it looks like the decline in the condo market is almost kind of stabilized a little bit for now. Prices are certainly down, but it doesn't really seem like they're plunging by any stretch of the means. But that's sort of the overview of those two segments. You'll have to see inventory to continue to increase if you want to see further or more significant downwards pressure on the prices. That's not to say that won't be happening, but I look at it and there's still a few things that are standing out. Particularly one is the household credit, what's happening in that. If you look at residential credit for the month of April at the Bank of Canada, it's still chugging around 3.2%, which is really like near 2-decade lows in residential credit. So unless you can get credit to pick up, it's really hard to see volumes and prices increase if you're in a low residential mortgage credit growth. That's really like one of the leading indicators that you have to look at. And despite rates, mortgage rates have fallen again significantly. You can get there's a credit union in Toronto area that's offering a 2-year fixed for insured mortgages at, I believe it's 2% interest rate, 1.99%. So mortgage rates have fallen significantly, yet there hasn't really been a material increase at all in mortgage credit, and sales volumes remain weak. I mean, you can see the same thing in Toronto, right? Everybody's talking, well, look how great the sales are, increased year over year. But if you actually look at even the Toronto Real Estate Board pointed out, is the sales figures are still well below 10-year averages. So yes, year over year they're up, but they're still extremely weak from a historical context. And so that's something, again, important to contextualize. So again, when I stress that sometimes the headline doesn't point the whole story, and you actually have to do a deep dive into the data and actually be quite active in that market to really understand it. And so again, same thing, we're looking at residential mortgage credit. There's a significant drop off in mortgage rates, which will obviously help. It might provide a temporary lift in volumes potentially, in my opinion. But at the end of the day, these rates, again, are falling for kind of the wrong reasons. Clearly, there's some weakness in the economy. The Canadian yield curve is the most inverted it's been since 2007. As you can see, the difference between the rates in the 10-year and 3-month. That's been a very strong recession indicator for a large part of history, right? So, I would almost be more concerned that the rates are plunging the way they are, because clearly the bond market smells something out. And it's very strange to actually see Bank of Canada's polos still has this hawkish narrative that he's going to try to raise interest rates, and everything, the data in the Bank of Canada's view seems almost encouraging, right? Like kind of a stabilization, quote unquote, in the Toronto housing market, record low unemployment. But meanwhile, things are clearly slowing down globally. The U.S. is obviously everyone's talking about a rate cut, and then you just have Bank of Canada's polos who's thinking he's going to hike rates on top of record high interest rates, record high household indebtedness, and really a housing market that is far from being out of the woods. Continues to be one of the interesting stories. So I'd imagine polos is going to have to take a pretty drastic shift, and I think he's actually painting himself into a pretty funny corner where, if the Fed cuts, this guy is not going to have much choice but to follow suit. So that's basically what we're looking at this week. These are continue to be the trends that we're setting in place. And what else? A couple other interesting stories. Continue to be fascinated in watching the construction space very, very closely. As I've said, I believe the construction space is the leading indicator for, besides maybe building permits, you should probably look at the pre-sale space in terms of future economic strength or growth. Lettingham McAllister, which is one of the larger developers, very, very well-established guy in Vancouver, just came out and said he's canceling 3 high-rise projects in the Burnaby-Coquitlam area, worth a valuation of about $1.2 billion. So when these guys start pulling back, that clearly the future pipeline of new construction is thinning, and that is going to weigh on the construction labor workforce. When real estate construction makes up 25% of your GDP, and these guys are canceling mega projects worth $1.2 billion upwards, that's going to have a significant impact not only on employment in that sector, but also migration flows, right? So you have a lot of people that are migrating here for work because you have a strong economy that, again, a lot of it is based on real estate and construction. So a lot of these jobs naturally are gravitating and filtering in to the construction space, which I think layoffs, well, they've already started, but they'll probably pick up once we work through this huge supply that's coming, just over 40,000 units still under construction, will be coming on in 2020, and developers pulling back on new supply, which in the long run, because it's very much a delayed effect, that will eventually then create the next shortage and the next leg up in the eventual housing cycle to restart again. But as it stands today, that's where we're at. So anyways, hope this video helped. Otherwise, see you next week.